Good morning, everybody, and welcome to the final demo day of this Digital Sandbox Pilot demo sessions, which are bringing us to the end of the pilot season, if you will. Today's focus is on preventing fraud and scams, the final of the 3 use cases. And just to remind you, this week we've already had the vulnerability pilot and the SME lending pilot. We're recording all of the sessions and they'll be available on the Digital Sandbox Pilot website. So if you haven't been able to have a chance, or you know people who would like to have a look, then please do kind of check them out. I'm really grateful to all the teams today for coming along and presenting their demos. I'm really excited to see what they look like, and an opportunity to kind of ask some questions of them as well. I'll spend a few minutes setting the scene and reminding you all of what this has all been about, and then we will leap very importantly into the demos. If you do have questions, please pop them in the chat, and we'll be curating those as we go along. I know the teams would really welcome your questions and your reflections, so please do use that, and we will curate those as we go along. So, Teresa, if we could go into the next slide, please. Thank you. So the Digital Sandbox Pilot has been a really exciting venture over the last few months. We accepted 28 teams out of nearly 100 applications to take part in this inaugural pilot program. And it's really been aimed at helping to support and further augment innovation within financial services. As I mentioned at the start, this pilot between the Financial Conduct Authority and the City of London Corporation has really focused on 3 specific use cases: vulnerability, SME lending, and the focus of today's session, fraud and scams. We've had 12 teams that have been developing solutions in relation to this. The pilot officially closed on the 5th last week, and the teams have had just under 3 months. They've had 10 weeks to develop their solutions. And today is really an opportunity, as I said, for us to really have a look and see what they have been up to. Teresa, next slide, please. So the purpose of this pilot has been to test really several hypotheses from insight that we have got from our wider innovation offerings. As you all know, we run a tech sprint program. We run obviously our very well-known innovation services around the regulatory sandbox. And one of the pieces of insight we identified, particularly from the tech sprint program, was there was a space to enable and assist innovators to really take that next leap from proof of concept through to proof of value, and really an opportunity for the wider ecosystem to observe and to sense check and engage with the offerings as they are being developed. We often heard that one of the key features of tech sprints was the data that we made available to teams to test and iterate their solutions through the phase of those tech sprints. But when the tech sprints came to an end, that data was closed down. And we knew that this was, what we were increasingly hearing was this was a missing piece in the puzzle to really enable those teams and those solutions to make that leap from proof of concept and to scale through to proof of value. So one of the pieces of that we have been really keen to focus on with this pilot has been developing synthetic data for the teams across those 3 use cases to test. We also knew that there was a real opportunity, as I said, to really engage the wider ecosystem, whether that was other regulators, incumbents, VCs, to really seek to be able to understand, observe and engage with the solutions that were being developed. And so a key element of this pilot has been to create spaces to collaborate and observe throughout the life cycle of the pilot, and that's been something that we will talk more about later. Teresa, the next slide, please. So I've mentioned a couple of significant features of the Digital Sandbox Pilot already. As I mentioned, access to high quality synthetic data sets. These were principally developed from a data sprint that we hosted last summer, a 3-week data sprint. And the data that we have developed in terms of scale and volume is significantly more than we would have for a normal tech sprint. And one of the important pieces that we are evaluating as part part of this pilot is the efficacy of that data, and what can we learn more about to really refine and enable greater use and engagement with that data. As I said, collaboration has also been a really key element that we wanted to test through this, and so an observation deck to really enable interested parties, as I mentioned, such as regulators or incumbents, to observe that in-flight testing has been a really important piece. There's been an integrated development environment to allow participants to really test and develop their solutions, and an API interface or vendor marketplace where regtechs, fintechs, other vendors can list their solutions and APIs. And that's about fostering greater interoperability to really engage and encourage a thriving ecosystem. The next slide, please, Teresa. So what's been happening over the last 10 weeks or so? Well, the teams have all been working away, not just in this use case, but across all 3 of them. And we've had over 800 users that have registered to create accounts and sign up to the platform. We've had over 5,000 unique views of the website and 600 total views of the showcases that we've run throughout the pilot program. We've been delighted to see the amount of engagement from the wider community. We've had 40 mentors from across industry, academia, regulation and tech have all leaned in to provide expert support. And over 100 different chat channels have been created to really collaborate and share insight and understanding. We have really, as I mentioned, been really interested to understand the efficacy of the data. We know that the Jupyter Notebook has been launched over 650 times to query the data, and we've had over 800,000 API calls to the data set as well. And during that time, we really encouraged the teams to engage with surveys that we have completed as part of an evaluation process to really understand where are we hitting the mark, where are things not, where could we do better and improve, and actually what are the drivers and dependencies around some of those. But my thanks to all the teams for really engaging and participating in that process. So today's session, each team will have, sorry, Teresa, I skipped ahead. If we can move on to the next slide, please. Each team will have 10 minutes in total. They will be kept strictly to time, and this will consist of a 6-minute presentation, after which Teresa will sound a bell and bring them to the end, a metaphorical bell, maybe not such a literal one. And then there'll be 4 minutes of Q&A from you guys. So this is again an ask out to the audience who are watching today. Please bring forward your questions, pop them in the chat bar, and we'll be curating those. Before I kind of introduce the first team, I just wanted to kind of remind us all really of why we are particularly focused on fraud and scams. And we will have heard the kind of particular raison d'etre for vulnerability and SME lending earlier in the week. We know that fraud and scams at any time are a pervasive and pernicious problem, but in a time of COVID, we have seen that fraudsters have really been using this as a hook to enable their scams, with over 20 new typologies utilising COVID that have been identified. In particular, the impersonation of authority bodies such as government, NHS and WHO have been an identity, a characteristic of the frauds that we have observed over the last 12 months or so. UK Finance said in September that their members reported almost 15,000 impersonation scam cases in the first half of 2020, and that was up over 80%, 84% compared to the first half of 2019, with £58 million lost. Outside of COVID, which has really greatly exacerbated the issue, as I said, fraud has a devastating impact for many. In 2019 alone, fraudsters sold over 1.2 billion from UK consumers, and 4% of adults in the UK have lost money in the last 12 months to one or more scams. So we know it is as I said, a pernicious and ongoing problem, which has only been exacerbated, unfortunately, by COVID, at a time when people are generally more vulnerable or newly vulnerable as a result of the circumstances of COVID. So it's really important that we're having a particular focus on this use case at this time. Okay, I am going to hand over to the first team. So I'm delighted to welcome Team Faculty AI, and I believe Catherine Branter and Lawrence Cowton will be giving us their presentation.
My name's Lawrence Cowton. I'm a senior data scientist at Faculty AI. And today I'm going to talk to you about AI explainability for financial services. And so a quick word on who we are. Faculty are Europe's most experienced AI and machine learning specialists, and we exist to make AI real for businesses across a number of different sectors. We believe that a key component of making AI real is to make AI safe. And to achieve this, we've invested significant time and energy in researching and developing AI safety tooling. So what do we mean by AI safety? We think of AI safety as the application of AI in an explainable, robust, privacy-preserving manner. So explainability enables users to understand why the model has made a particular prediction. Robustness enables the model to determine when it should and should not trust the predictions it has made, such as if the input data is significantly different from that which it was trained on. Privacy ensures that the sensitive information in the training data does not leak through the model, and fairness ensures that all the protected groups within the data are treated fairly. So today I'm going to focus on explainability, but faculty has tooling to address each of these areas, and we'll be more than happy to discuss any of these with you if you're interested after this. So when it comes to AI models, there's a commonly held belief that explainability is traded off against predictive power. So you can either have a sort of low-powered, intrinsically interpretable model or a high-powered, complex black box model. However, with the right explainability tooling, we believe that you can actually deliver explainable and high-performing AI models. Now, there are many open source explainability tools out there, but many of these suffer from major shortcomings in their approaches. Most commonly, these algorithms assume that the features in the data are independent from each other. And this assumption doesn't really hold for real data sets. Now, faculty's explainability tool doesn't actually need to make this assumption, which boosts both the accuracy and the reliability of the explanations we produce. And our research has also enabled causality or any other structure that's contained within the data to be factored into those explanations. And we also have methods for explaining high dimensional data, such as images, in terms of a small number of human understandable features. So that's about our explainability tooling, and I'm now going to demonstrate how this tooling can be applied to a fraud detection use case using some of the data from the FCA Digital Sandbox. So the synthetic transaction data contained within the sandbox contains fraudulent behavior in the repayment of bounce back loans over the course of 2020. So this figure here shows the repayment histories for a random sample of 10 entities within this data. But in order to simulate a sort of realistic fraud detection scenario, we're going to focus on a single date, which is the 1st of June, and look at the data from the period immediately preceding this date. So if we zoom into the 1st of June, we can see that for our random sample of 10 entities, the repayment of these loans over this time period was fairly slow, and the transactions that are being, the transaction values are also sort of relatively low. So how do we actually go about detecting fraud in this data set? Well, the first step is to engineer features about the repayment of these loans from their repayment histories. These features might be things like time since the last repayment or transaction value as a percentage of the total loan value. So we can then take these engineered features, pass them through a dimensionality reduction model that allows us to derive further features from this data. And so we end up with something like the figure on the right. The actual sort of process of this is relatively not important for the sake of this talk. But once we have this sort of new data, we can then pass this through sort of classical anomaly detection algorithms such as isolation forest. And these helps us identify these red points here as being more anomalous than the gray points in this figure. So, okay, so now we have a group of entities that the model has flagged as anomalous. And now we need to somehow manually verify whether these are actually examples of fraud or whether the model has got this wrong. So there's two ways that we can do this. We can either just pass a list of the IDs of these entities that have been flagged as anomalous to subject matter experts and let them start investigating from scratch, trying to infer the elements of the data that the anomaly detection algorithm had flagged as anomalous. If the data has a lot of features, or if the anomalous behavior is hidden in correlations between some of these features, this can be just incredibly hard to find and can be a really, really slow process, as I'm sure many of you are aware. If there are also a large number of entities that have been flagged, then this task just becomes really, really enormous. Alternatively, we can pass the ID and an explanation of the prediction to our subject matter expert, and this enables them to rapidly pinpoint exactly why the model has flagged this entity and to verify that decision. So if we put our subject matter expert hats on and go back to this example, here's an explanation of why this anomaly was flagged. And these are things like the mean repayment value as a percentage of the total loan, or the mean repayment value per day. And so we can see that these entities are paying back these loans in large amounts over a very short period of time. And so if we look at our transaction histories for these flagged anomalies, we can indeed see that these are large value transactions over a short period of time. And we can compare those to our transaction histories. There's a clear contrast between these two different sort of states of paying back these loans. So hopefully this example has highlighted the benefits of incorporating explainability tooling into your machine learning workflows. However, as I said before, explainability is just one tool in the AI safety toolbox that we've created. So if you'd like to talk more about explainability or any of these other areas, please do get in touch after this talk. And I'll leave our email addresses for me and Kathy on screen now, but I'd welcome any questions as well. So thank you.
Thank you very much, Lawrence. So we have had a question from Lucy. How do you avoid the issue of criminals learning your red flags and avoiding them?
That's a really good question. So, I mean, well, I suppose in order for them to do that, they would need to have some sort of internal knowledge of the process that we go through. I think it would be relatively difficult to infer that unless they had a large amount of data on which anomalies we were flagging without, as I say, some sort of internal information. But as I sort of described in that talk, I think the key takeaway here is not so much the algorithm that you're using to detect anomalies, but the fact that you can explain that detection, and that will sort of help speed up your process of identifying fraudulent behavior within your data set by the subject matter experts.
Thank you. And another question, if I may, how much more accurate would you expect this system to be over a rules-based system?
It's very hard to quantify, so sort of give a sense of improvement. I mean, I would definitely expect it to be more accurate. It will be able to it'll be able to detect different types of anomalies, importantly. Rules-based systems will only really be able to detect extreme value anomalies, whereas machine learning algorithms will be able to detect correlation anomalies that will be much harder to detect than just simply sort of saying this is at the extreme tails of our distribution for a single feature. So you can see how maybe two different features trade off against each other, and maybe an anomaly breaks that correlation that you would expect to see. So I would definitely expect the machine learning algorithm to be able to detect new and different types of fraudulent behavior that you wouldn't expect to get with a rules-based system.
Wonderful. Lawrence, the questions are flooding in, so I might just ask Teresa if she can let me know how many more questions do we think we can take before we start to impinge on the next team's time. But one of the questions coming through is, can you tell us more about the process by which you acquire expertise from subject matter experts to automatically identify red flags in ownership?
Apologies if this perhaps wasn't clear in the talk. The idea with this sort of workflow would be that so subject matter experts would pass on their domain knowledge to developers for these algorithms, so developers could incorporate as much of that expertise as possible into their algorithms. The algorithm would then flag a number of entities that they suggest are anomalous, and that information would then get passed back to the subject matter experts so that they could then verify the algorithm's decisions. And the benefit of having explainable AI at that point is that those decisions are clear and obvious to the subject matter expert, and they can really zoom in on exactly why the algorithm has flagged it in the first place, rather than just knowing that, you know, something slightly suspicious is sort of happening with this row of data.
Fantastic, Lawrence. There's been lots of questions, but in the interest of time and moving on to the next team, we will move on. Thank you very much indeed. That was really helpful. So the next team to welcome is Team EalaX, and Edgar Lopez. I think you are presenting on behalf of the team.
Thank you very much, Francesca. I'm Edgar Lopez. I'm the founder and CEO of EalaX. We specialize in advanced simulation and fin crime analytics, and we're happy to be part of the Digital Sandbox Pilot, not only as a participant, but also as one of the teams that helped to build this. So we are currently working in a solution called Synthetizer. And Synthetizer, well, we want to bring to the financial organizations internal sandbox. And this internal sandbox will generate synthetic data on demand for the organizations, and also for companies like the ones Lawrence is working, just for you to provide, just for you to understand better your solution. And so what happens is that organizations have a bunch of, say, hidden crime inside their real transactions. And every financial institutions have a transaction monitor system in place. And this transaction monitor system have some of the, let's say, rule-based scenarios or machine learning, and they generate some alerts. And the big question is the one that Francesca asked, how good they are. I mean, how much effective crime do you find? And sometimes this explainable AI helps you to do this. But comparing one to another is one of the hardest tasks that we have right now. So solutions like the ones Faculty AI is producing can really change the way we currently do financial crime analytics. But it's hard to actually understand if these solutions are actually better or worse. So that's why we are providing the financial institutions with well, a solution called Synthetizer. And what we want to do is to break some of the problems that we have in this field. And one of those is confidentiality. So we want to extract from the real data some non-confidential parameters, and we want to add the expertise that we have of what we know about fin crime topologies. And we want to combine this with the knowledge that the institutions have to generate a simulation environment and provide this as a service. So the data scientists will be able to actually generate different scenarios of synthetic data. And these scenarios will be the ones who power the machine learning algorithms. So machine learning is one of the, let's say, possible solutions that we have for solving the problem or for addressing the problem of fin crime. But it is required for machine learning to have high quality data. So organizations like Gartner has predicted that by 2024, at least 60% of the AI in the world will be trained using synthetic data. And there are a lot of advantages of using synthetic data. And one of those is that we can actually generate these scenarios, so we can test several machine learning algorithms at the time. And since we have the labels, we can actually benchmark them. And I think that's one of the key aspects to answer questions like the one Francesca had about Faculty AI. How much improvement do you have over other algorithms? So the ideal situation is that we do this in the lab, we train this, and we finally go and deploy. And time for deployment is one of the pains in the organizations, because since the time that we actually identify some of the threats, it takes a lot of time for the organizations. It could be 6 months to 1 year. And this doesn't actually help the race of catching the bad guys. So if we can, let's say, minimize the time of deployment of AI, but not only whatever way AI is effective AI that we have been testing in the lab, we will be able to inform the law enforcement authorities with quality information that will help them to catch the bad guys. So in EalaX, I think the digital sandbox was something that was very good for us. And basically because at the time that we joined the Digital Sandbox Pilot, we got a couple of grants from Innovate UK. So one of the grants is for the project called FraudSyn. That is an optimization tool for the readjustment of the new normal. And we're working in creating quality synthetic data for AI, and we're focusing on in COVID fraud. And the second grant that we got was a couple of months later, was CPMark, and CPMark focused a lot on benchmarking this, so in trying to understand which one is better. So just to give you a little bit of overview, and not too much, what we want to do is to connect from the real data, to go through all the process of synthetic data, generate parameters, evaluate the controls, and finally benchmark. So FraudSyn and CPMAR are just part of the solution that we call Synthetizer. So just talking about the digital sandbox is, I think the project itself is fantastic. It's one of the ways that we have to validate our solution. So supporting innovation in financial services is probably the best way to describe the digital sandbox, and that's what they're doing for us. And we're particularly using some of the data sets that we helped to create. So some of those are the banking transaction, BankSyn, PaySyn, and the banking data. And we also use the synthetic entities and individuals that were provided before. So basically we use this in a process called bootstrapping. So we learned previously the techniques, and we apply these techniques on these data sets for extracting the parameters, and at the end to generate the synthetic transactions. So what the digital sandbox provide was the possibility to do all the analytics, to check the validity, to understand where are the points for improvement. So I'm not gonna stop too much in the analytics. I have a lot more slides if there are some questions about that. But one important part that helped us is the injection of fraudulent agents. With the injection of fraudulent agents, we study a particular problem.
Hi, Edgar. Sorry to interrupt. I'm just giving you a time check here. If you could wrap to your last slide. Sure.
I'm just gonna wrap up. So with this injection of fraudulent agents, we can generate different scenarios with all fraud, some fraud of injection time. And this would provide us actually the input for the benchmarking. And the benchmarking tool will be a tool that will help the compliance officer to understand where is the organization at risk. And the important part here is that we bring new analytics, and one of those is the generation of metrics with the hidden crime. So finally, just to thank some of the collaborators, and one of those is Graham Barrow from the Dark Money Files, that he's been a mentor also in this field. And I'm open for questions. Thank you.
Thank you very much, Edgar. So we've had one question through. When you inject malicious behavior, does this mean the data only contains fraud typologies that we already know about, or can it start to include unknown typologies as well?
I mean, the possibilities are quite wide. So we can start using some of the things we know. And, you know, artificial intelligence is quite good to detect some of the patterns that we know, but it can also create a wide range of vulnerabilities. So basically, we start with the concept of injecting what we know, but we aim to actually create a wide range that will later show the organization the gaps that they are exposed
to. Okay, thank you. Any further questions from anybody? I can't see any coming through. Thank you, Edgar. That was fantastic. Thank you very much indeed.
Thank you very much.
Okay. I am going to move on to team Synetics Solutions and ask Chris Lewis if he can take the floor and present.
I'm here presenting, but the work is predominantly done by Rob Bevington and Luke Aberley, our head of data science, and one of our data scientists. And I'm just here to talk on their behalf. I'm sure they'll Skype me if I say anything stupid. Anyway, just about Synetics, we've got 28 years of experience at the thick end of fighting fraud. We host the two largest UK data sharing databases for the purposes of fighting fraud in National CIRA and the NFI. And we got the Queen's Award for Innovation in 2019 for the work that we do in machine learning. So we thought this would be a nice opportunity to compare the real life data and machine learning models that we operate versus the data that's available within the sandbox, you know, the synthetic data specifically. We first off, we wanted to try and classify authorised payment fraud by utilising the transactional data that's held within the same stuff that Lawrence at faculty just spoke through in the first presentation. We basically did some preliminary analysis and came to a similar conclusion as Lawrence did, and decided that we actually weren't going to build the model. This was largely due to the nature of the data, the lack of vital membership functions, and the fact that the only real variable that we could use is the amount variable. We couldn't really create a particularly predictive model. So we didn't think it'd be a particularly good benchmark versus some of our existing ones. So we decided to just move on and try and use a different one of the synthetic data sets and create an alternative model. So we moved towards using the synthetic account data and comparing it versus our precision national model, which is basically a machine learning model that operates across our data sharing consortium to score current accounts in alignment with actual applications for current accounts in the UK. So we took the current account data, and when comparing it against the real world data, we saw that there was some, you know, sort of medium risk type referrals that were created by utilising the variables that we were able to input. So it's mainly personal details and address and all that sort of thing. But we had nowhere near enough high risk referrals compared to our real life model, which suggested that some of the sort of intricacies that actually predict and indicate fraudulent behaviour in a real life scenario weren't necessarily present in the synthetic data that we used, or indeed our model needed a bit of tweaking to identify these more high-risk activities. So I think the short story will be that we weren't really able to classify what it is that we wanted to by utilising our current account model. So that all being said, you can see that there's a massive variance between what we perceived high risk and medium risk to be across the world that we operate in. So we see about 5% of all current account applications being within that high risk, potentially fraudulent banding, versus 0.01% that we identify within the synthetic data. And the synthetic data had a much higher proportion of low risk accounts within it than it did compared to the information, again, that we hold in our national consortium. We've got a couple of examples as well. So on the left-hand side, we have a medium risk referral that we've taken from the Digital Sandbox. On the right-hand side, we have a real-world applicant. We can see there's a strong correlation that the email mailbox feature and age of application are all having a large importance factor on the score. And the key thing here, now I'm sure Luke will be laughing at me in the background, is that there's not very many negative importance factors on the score, which basically indicates that we're only getting stuff that's predicting that fraud is happening. We have nothing that's predicting that fraud isn't happening here, which is one of the key things to basically identify whether something's legitimate or not. Not just the stuff that looks bad, but the stuff that looks genuine as well. And in our three examples we've got, you'll see that we didn't find any features in any of the applications in the Digital Sandbox that were representative of a negative importance score, which again shows that there needs to be a little bit more refinement into how the synthetic data is generated for it to be as predictive as real data. So we've got a nice conclusion here. I think the key thing for us is that a lot of the most predictive features that we have on a national basis, the likes of email address, telephone number, GIS, are both real world and have quite a prescribed format, so it's quite easy to understand, you know, what's fake and what's real. I've got a real life use case, for example, where there was a large fraud ring in the insurance world, where it was a football club's name followed by a series of numbers and lots of email addresses generated using that format. It's really quite easy to then predict other things that fit within that particular typology. Whereas here, the email addresses were basically almost nonsensical compared to a real email address, which therefore meant that that feature was useless. We'd say the same for the telephone number. So formatted in lots of different formats. They never use mobile numbers. And in the digital first world, we see mobile number only accounts being more predictive of fraud than ones that use normal landline numbers. So again, didn't necessarily represent what we would expect from an actual fraudulent application. And a couple of other things, so all of the addresses were fake and didn't actually align to the telephone numbers. So there was no way to do any sort of geographic analysis. He's applying from Leeds, but he's based in Cornwall. Clearly, that's going to be indicative of something, maybe some sort of compromised identity or something like that. But when the whole thing is nonsense, it became very difficult to then identify and classify that sorts of those sorts of frauds as well. So we did our first piece of work on this, and if I've got time, we then decided to think, well, we've got computer-generated data. How about we create a model that uses the computer-generated data to identify computer-generated data within our databases, within our own syndicate? So we tried to create a synthetic identity model using the synthetic data. And this was actually really quite successful. So we managed to successfully, I'll share these slides because I know you won't be able to read them in time. We managed to successfully classify the best part of 30% of impersonation fraud using the synthetic identity model across the top 15% of high-risk applications. So actually, the fake data that was generated within the exercise could be used with a little bit more refinement to help predict fake applications using fake identities in a real-world scenario. And we think this is quite an exciting and interesting insight that we got from going through the sandbox process. So, all being said, we think the entire exercise was incredibly valuable. We'd love to use the methods that we applied during this entire exercise to help the likes of EalaX refine the synthetic data generation process, align it more to what we'd expect to see from real life data, from the stuff that we hold within our data sets. And we'd love to take part in any future initiatives around this, because we do think that our expertise in actually gathering real world information and using it to predict actual real world fraudulent behavior would be really beneficial to the people that set up this, the sandbox, and indeed the refinement of synthetic data moving forwards, because there's no arguments that synthetic data is an absolute mandatory requirement in the world of GDPR to test and use new technologies in an open and easy manner, like we've been able to during this exercise with the sandbox. So yeah, that's it. Any questions, please?
Thank you very much, Chris, and thank you very much for kind of really teasing out and offering some insight around that real world fake identity and synthetic piece. We do have a couple of questions. Do you have plans to roll out those fake identity models into the real world? Is the first question. And if I can just throw a second question in as well, how commercially viable do you think this might be?
So I think absolutely, we would love to refine the synthetic data generation process to basically make the synthetic identity model more predictive. I think it's a really good output from the whole process, and we would love to apply it in a real world scenario. I think for us, we basically need to use the information that we capture, the 300 or so million rows that we currently use for the generation of these models, and then identify probably some high-risk features, work with the likes of Edgar and the team at EalaX to see, is there anything that we can learn and show that help you to refine the algorithms? Because at the moment, it's not quite enough, I think, to demonstrate a tangible return on investment if we were to deploy it at one of our clients at the moment. But that's not to say that it's not a great starting point for what could be an incredibly compelling product. I mean, my first hypothesis was that I didn't think it was even going to work, because I thought that obviously what Edgar's done and the team have done to generate the synthetic data is not going to be comparable to what a Forrester's done to generate a synthetic identity. But it transpired that some of the features actually did strongly correlate across the two, particularly around the likes of the email address and things like that. So yeah, absolutely, that would be the short answer to your question.
Thank you very much. I can't see any other questions coming through, so I will say thank you very much, Chris. That was a very energetic and energizing presentation, and really interesting, so thank you. I'm now going to
thanks.
I'm going to now move and ask team CallSign, Bhavesh and Chris, if they can take the floor.
Good morning, ladies and gentlemen. Thank you for attending today. My name is Bhavesh Vagela, VP of Products. I'm joined today by Chris Stevens, Head of Financial Services Solutions. We looked at this in a slightly different way. So let me just give you an overview of CallSign. So CallSign was founded in 2012 by Dr. Zia Hyatt. Essentially, what we do is we look at passive and active telemetry, and we use intelligence and data learning models to identify genuine actors and bad actors. And essentially, what we do is, with context, give friction or security friction to telemetry where the data might be bad or we're not sure, but also balance customer experience with security. So if we go into kind of the issue we were looking to solve, we were looking to solve APP fraud, but from the lens of social engineering. And there's three issues that we came across as we worked on the Digital Sandbox. One is detection, one is the intervention, and then one is the overall experience. So when we looked at this and we collaborated with a number of people within the Digital Sandbox, and we also were lucky to partner with HSBC and get some real life examples of these three areas. What we found was how do you detect when a customer is at home using their device in their location and making a payment, which could be a fraudulent payment through social engineering? The other one we found was when you provide generic error messages, they become noise, and customers just then ignore that noise and just carry on and do the payments. The other two things that we found were fraudsters get very clever and understand the customer journey from a banking side, and they're able to coach the vulnerable customer through that journey, and ultimately then are able to get the money from the customer. And then finally, how do you make sure that you're only alerting when it looks like it's going to be fraudulent, than alerting everyone? Because as soon as you start alerting everyone, it becomes noise. So what I'm going to do is hand over to Chris, and Chris is going to go through the solution and also do a quick demo. So over to you, Chris.
Cool. Cheers, Bav. Yeah, so the CallSign technology is embedded in the user journey. So we passively analyze things like the device location behavior, and we combine that with other analytical risk feeds. So doing some things like looking at the transaction risk, doing some beneficiary analysis, telco intelligence, assessing the customer profile. And then, as we touched upon, the behavioral biometrics as well, which is a great way to identify a change in the user behavior. So we use all those bits of information, and when the thresholds are breached, we then introduce these dynamic interventions. So these are questions and fraud warnings that are very tailored to the specific risk that's been identified. But to Bav's point, we don't do that for the majority of transactions. It's the minority that actually are presented with these warnings. So when customers see them, they know that something's a bit different, with a view then that either they can be, we can then inform the customer, and the customer realizes they're being scammed and they stop the payment, or actually we capture enough information to know that the customer is taking long to answer these questions. They might be typing differently, and so we can actually infer that the customer is being socially engineered. So that's kind of our approach to this, and I'll just show you a quick demo of how this works in practice. So this is an example banking implementation, so it has our products baked into it. So I'm going to go and log into Southfields Bank. So I'm going to go ahead and type in my credentials. Click login, and I'm logged straight into my account. So when I actually logged in there, we performed a lot of analysis around the device location and behavior. And actually we realign with strong customer authentication. Just by typing in that username and password, I've actually performed 3 factors. So the device is a possession factor, that's 100% recognized for me, work laptop. Location, as with everyone, it's not changing too much at the moment. And then keystrokes, so not only did I type the correct password, but the way I typed it is consistent with how I normally type. And so that acts as the inheritance factor. So if I go now and make a payment, and I'm just going to go and set up a payment, so I'm going to pay Bav, and put in some account details for him. And I'll pay him for dinner. This was quite a long time ago, a bit of an overdue bill when we were allowed to meet. save that and confirm it, and the payment goes through straight away. Now, if I repeat the process, and I might do a slightly higher risk transaction, say I'm paying HMRC, I'm going to put in the actual HMRC bank details and their account number. So this is something that will be assessed by our system. And I'm going to pay my self-assessment, save that, and confirm. I get a different user journey. It's asking to step up the authentication, and I get my SMS through on my phone. I'll type this in, click next, and confirm that. So this isn't anything different to the what you're used to with your existing banking setup. But essentially, we're assessing the risk, and we're not changing anything particular related to the user journey. But what I'm going to do now is I'm going to log in, and I'm on the phone. So what's the difference here? Well, I'm typing with one hand for a start. So I'm typing in my credentials. I'm being coached to make this, to log in. So obviously my behavior is going to be a little bit off to how I normally behave.
Hi, Chris, just a time check here. So I know you're doing a demo. If you can go through that a little quickly, since we're at the 6 minutes.
We're getting that. So I'm stepped up to facial recognition. That's what we've set up in the journey. I click continue. And now I'm going to go ahead. Say that again. Repeat the process. Cool. So I'm going to step up to facial recognition, provide my face. I'm logged in. Now you can see the keystroke is down at 1%. So it recognizes this one-handed typing, this deviation. I'm going to go and make a payment. So now I'm going to pay someone new, and I'm going to say I'm going to pay Chris Stevens. So I've been asked to move my money to a safe haven. I put in the account details, and I put in an amount. So now I'm going to click confirm, and I get a different user journey. So I'm presented with these interventions. Did I expect to make this payment today? No, I was on the phone to my bank. They said I need to move my money. Is this an unexpected payment request from Bank of Police or HMRC? It is. I click yes. And then I get presented with a warning, tailored warning, and asking me whether I wish to proceed. So I might click stop payment, and the payment is cancelled. Now this is all driven by our backend, our decisioning component that determines what is the next step, what questions should you ask next, and what conditions under which that question should be asked. So that's a quick kind of demo of how our system works. It's very flexible. You get full control of those journeys. And as you see new fraud attack vectors, it's very easy to update those warnings and the conditions under which they're applied. And yeah, happy to take any questions.
Thank you very much indeed, Chris. We've had a few questions coming through. So how does your keyboard input analysis compensate for people who use password managers to autofill details?
So yeah, we recognize what's a deviation in the norm for a user. So where they normally use a password manager, we pick that up. But it's very much a case of we also look at things like how long they take on the page. It's not just the password page that we look at, it's all the different pages when they're navigating through the system.
Mm-hmm. Thank you. And earlier on in your presentation, you said we found on the app fraud on the Rise slide. Can you talk to us about how you found this?
In terms of app frauds on the rise, so we speak a lot to a number of banks. So we in combination with HSBC, we were going through this, and we actually looked at some of the the most recent fraud trends. So everything from the vaccine scams to there's a big one at the moment around Bitcoin. Everyone's trying to buy Bitcoin because it's going up, and it's tricky if you go through Coinbase. So there's people that happily help you buy some Bitcoin. So we've got a whole load of industry standard templates with these questions behind the scenes that help detect all these different fraud MOs. But ultimately, it's always changing, and so that's where our clients can make these changes quickly.
Wonderful. Chris, there are quite a few more questions in the chat, so maybe I can ask you to turn your attention to those whilst I now move on to our next presenting team. Chris and Bob, thank you very much indeed. So our next team up is Financial Network Analytics, and Brandon Smith, I think you are taking the floor for the team.
Great. So we're FNA, myself and Matteo are here. And today, what we want to talk about is how we use the Sandbox Pilot's synthetic data to apply two different schemes for compliance organizations, whether you're looking at fraud, business risk, or anti-money laundering, to conduct a basically a ensemble-based approach to identifying anomalous or high-risk behavior very quickly in a lot of data. So we'll get right into it. A little bit about who we are can be seen here. And if you'd like to hear more about what we're doing and other solutions we have in other areas, of course, we're here to do that. We're heavily we participate heavily in academia, as well as the business and industry. Our work spans academia, central banks, financial market infrastructures, corporate banks, and more direct with some of the work that I do personally, the Department of Defense and intelligence communities. So we'll jump right into the problem we have today, which is that most of the time in compliance risk monitoring, most of the data, which are the cases that are generated by centralized monitoring systems, are unproductive case volumes. So it's unlikely to generate a suspicious activity report or some sort of alert that will actually inform law enforcement or government of what the actual typology of risk is. So what we're simulating here to the left is we've selected one node that was in the FCA sandbox, and just emanating from 4 degrees of relationships with the one node, you can see some of the statistics that we have. So, $37 million plus worth of transactions, and transactions ranging from 285 all the way up to almost 100,000. 411,000 individual transactions across 3,225 entities that represent 17 distinct business segments, all of the business segments available actually in the SIC code database. So generally what we would say is, well, that's already a data reduction. We're only looking at the ecosystem around one node and there are one entity's behavior for one day. And then what we say is, well, what if we took the traditional risk score that was already in the data? So we were able to ensemble that risk score based on the all of the data about, maybe risk, credit risk scores and things of that nature. And you still have 568 entities to consider if you just looked at the top 10% of the risk in this network. So that's still too much for anybody to really dive in on. Why is that? It's because compliance-based rules are designed for keeping financial institutions compliant more than they're oriented toward actually finding suspicious behavior, and that criminal enterprise adaptation can outpace regulatory kind of red flags and schemes that we come up with, especially in rules-based monitoring, to try to catch them in their financial transaction behavior. So what we suggest instead is that instead of focusing on that focal entity, which is what most people do today when they generate a case or they generate, let's say you're a company that wants to underwrite this person for insurance, doesn't matter what it is, we use the full breadth of just transactional data as well as the data about the people in their network, such as their risk scores, all the data you would get from something like Companies House or another data aggregator. And we suggest that you evaluate networks, evaluate the risk of your focal entity in this context. So what you have at the end of the day is relationships to other people that can influence the initial score. This could be a business risk score, business failure score. This could be an AML risk score. But you base the risk, you modulate the risk of the focal entity based on their relationship. Thereby, somebody who seems very safe at first could actually have an increase in risk or an increase in business failure risk, or somebody who seems as though the risk is very high to begin with. When you consider the behavior in the rest of the network, actually they're transacting with people in a manner that makes sense for their network, and therefore the risk can be seen as decreasing. How do we do this? We basically use two different approaches. The first one we just showed was creating a behavior risk score based on the relationships and the relationship data, utilizing network science tenets. Matteo, our data scientist is here to answer any questions that you may have about that. And then the second is that we used a neural network that was trained to identify members of each segment that say they're a member of one part of a business segment, but actually behave as another part of the segment. Prior to the FCA Sandbox, we had tested this approach on real data from the World Input-Output Database, and we were able to find in a simple visualization members that say they're supposed to be one segment, but in their behavior, we see them as outliers, well entrenched in another segment. So we wanted to then bring this to bear, as well as combine the relationship risk scoring with this approach in the FCA Sandbox data. So the results of this were actually pretty good. What we were able to do is take a look at 2 weeks worth of transaction data, perform a day-by-day analysis of it, and then identify day by day, node by node, what are the most risky members of the network given a base node. So if you have one member of this network, because you have to consider every member of this network in your monitoring, for every network in the monitoring, you can generate a list right up front of the most suspicious members of the network, suspicious being those that don't conform to their segment, combined with how they permeate risk through the network. So this is what the network looks like by itself. This is photo one. As we talked about, 3,225 entities. Apologies, this little call out box is supposed to pop up in the third picture. Photo two, as we talked about, this is if you just decreased it to the top 10% of your normal risk scoring. And as you can see, by node size being the risk, it's very difficult to discern who the risk is. But here in the third picture, this is what we're able to reduce that whole network to, is around the focal entity, you have all of the industry sectors that they represent by their shape. You have the volume of the transactions that are going between them by the density of their links. So all of this is customizable. And then as you can see, there's blue and dark blue. The dark blue nodes are those in the networks who say that they were one thing, but behaved as another. So in this case, this Vertex ID, which is one of your FCA entities and organizations, they said that they were a member of, SIC codes 86 through 88 in health, but we were actually able to predict that they were actually a member of a completely separate sector. So instead of being in sector 11, we predict that they are in sector 2. So
hi Brandon, sorry, I'm just giving you a time check that
sure.
Your presentation time is up. Oh, awesome.
Absolutely. So what that looks like in practice is we've simulated that we have this whole network. Here is what would it look like if you tried to reduce that giant network to just that same focal ID. But the output on that focal ID is actually here. We can build the network. And so if you're the investigator or you're doing due diligence on this, you would build this network out. You can say what links matter to you. Maybe you can also do this by transaction amounts, so on and so forth. And then the idea here would be as these load, because it is loading through a ton of data, you can come in here and then say, well, I would like to just know, is there a suspicious actor, meaning they say they're one thing but behave as another according to their category, which are now in orange. And instead of the business failure score, we'll take a look at the new business failure score, the enhanced. So now what we have is a very quick way to say, out of thousands of entities, I care most about these ones here that are non-conformers, as well as the ones that have an increased business failure score that negatively impact this focal ID that I'm looking at, again, for AML or maybe business decisioning. So in total, had you gone through all 3,000 nodes, you would have generated this list of this 28 that are in its ecosystem that you should care about the most. And as you can see here, all of the data about from the sandbox is here about each node. That concludes our presentation, and we're happy to take any questions.
Thank you very much indeed, Brandon. So I think we have time for maybe one question. So I might direct you to the chat to see if you could answer any more that come through, please.
Okay.
How does the relationship network analysis work when the customer has multiple accounts, at multiple banks? Does it require banks to share data with each other?
That's always the concern we have, and often my experience in trying to improve compliance monitoring systems does include multi-bank analysis when I was at Citigroup. And what we found is that high-risk individuals are more likely to have their behavior explained as lower risk when you combine banking data across banks. The hard part about that is yes, you would have to have a very targeted reason to, kind of request information from another financial institution about the same customer. If the same client has multiple accounts within your same firm, in the network science point of view, what we would do is just merge those entities, or you might be able to decipher behavior between, let's say, organizational accounts versus individual accounts. So you may want to keep them separately and monitor the behavior separately, or combine them and get a more holistic view of, here's Brandon Smith's personal checking, but Brandon Smith also owns the accounts that are transacting for Brandon Inc., for instance.
Okay, thank you. As I said, there's a few more questions in the chat, so if I can direct you there to maybe pick some of those up, that'd be really helpful. Thank you very much, Team Financial Network Analytics. I'm now going to go to Team LexTego. I'm sorry if I pronounced that wrong, my apologies, but Junaid and Rob, you are leading the team. Welcome, and over to you.
So my name is Junaid. I'm here to present our proof of concept. We are a pretty new startup. We less than 6 months old, so it's been a bit of a whirlwind last 3-4 months to get this proof of concept up and running. We are working together with a firm in South Africa called Cybrin, who provide core banking platforms across Africa and have over 300 customers. And we are building this for the Bill and Melinda Gates Foundation. It supports their level 1 project about bringing financial products and inclusion to the poorest. And our first implementation is with the Loop Foundation, which is an open source switch. So kind of think analogous to faster payments here in the UK. So first up, why open source? We believe it's a shared problem. And what we hope with Axio, with the product, is that we create a starting point for fintechs all over the world. So I will dive into our actual concept. So this is the fraud risk management holistic concept that we have. So you have a payment being fed in, or a transaction fed in from Loop to us. There's some preparation. We are currently doing a rules-based approach, and for the rules in the typologies, at the moment we have identified 270 typologies. From there, we have an analysis and outcome, and the transaction is fed back into the hub, and the transaction is processed. So through this whole journey, one of our big questions and the big learning from us through the sandbox is understanding our operating models. So we came from a place where we thought, are we going to have to go either fully distributed or a completely embedded system? And it's about understanding our characteristics that we need to be aware of. One is that the hub and the financial institutions are going to want to potentially do their own thing. Maybe you need to have a trusted party in between. And the sandbox has really made us understand how we would actually deliver a semi-attached or a standalone system. So that has been a big outcome for us. And our vision is probably more of a semi-attached, where we have shared compliance and a trusted partner or a hub operator, which allows for banks to, which directs and points banks in a certain way so that they can actually do certain types of investigation. So what was our challenge? We needed lots and lots of data. So 270 typologies, trying to hide our fraud in all of that data is a tricky problem for us, and the FCA sandbox has helped us to do that, especially because we need to run at 3,000 transactions a second and being able to scale and handle 10,000. So that almost ends up being 1 billion transactions a day. What have we done in the sandbox? Quite, I would say. We have had to adjust the transactional data. So for instance, more granular timestamps. There was only, I think, 4 timestamps that need to be expanded, and allocating more individual data, so passports, IMEI, driver's license, etc. And the other part which we've gained valuable help and coordination and learning is through the mentors and participants. So broadening our view of what is possible, as I touched upon in the operating models. We have collaborated with Sedicii, and I'll get to that as I present our proof of concept. And thanks to the mentors, I've mentioned a few here, but there's been a lot more that we have talked with and who have helped us on this journey. So our actual proof of concepts, if you want to see the demo, I've provided a link here. I'll try and splice a video later into our showcase. But what we have done is take 20,000 users, so that equates to 1 million transactions, so typically a year's worth of transactions, and we fed it into our system and across 4 typologies. The actual top part here shows a kind of the transactions a second over the time that we played this through. We went to peak at 10,000. Where our issues and what the data really has helped us with is understand where our system broke. So as we build up more and more historical data, the system slows down. So we can still achieve our 3,000 transactions a second, but we need to be aware of this as more and more historical data is built up and more analysis is done against these typologies. So once you have the typologies scored, the results look something like this. So we can see the highest scores is from, say, Ashley Scott paying a Russell Hunter, but there's 102 Ashley Scotts and 37 Russell Hunters in the data. So in the next part of this journey, you have a problem that you need to investigate. So how do we investigate? Well, we have partners and people and solutions that can help us. In this case, Sedicii. So in the next presentation, Sedicii will, as part of their demo, show how this is done. I should also add, in real life, you don't see all of this information. This is just here to kind of highlight what we have. And that is another crucial point, and the help we need from other tools to be able to have financial institutions speaking to each other and discussing in a way that doesn't break any data and privacy rules to be able to do this investigation. So what is our next steps? We need more realistic data synthesis and doing it on a larger scale. As I said, there's 270 typologies, and we have a lot of raw typology calibration to do. This was just our proof of concept. We've achieved what we wanted, and the MVP will demand a lot more. Another key area for us is the security and privacy side of things. The actual engine itself will be open source, but you can't open source the rules and typologies. You can't be, as we deemed the thieves' cookbooks, and give them to bad actors and for them to dream up new ways that they may not have thought of. We need to increase community participation. As I said, this is an open source project, and the more participants and more interest we have in being able to help them build a better project and the tool is in everyone's interest. And lastly, we need to also think about how our commercial model will wrap around this so that we can continue and support the journey that has been started by the Bill and Melinda Gates Foundation, and we want to continue this journey, and for that we need a commercial model and to work that through this year as well. So that is me. Thank you.
Thank you very much indeed, Junaid. I can't see any questions coming through. So
there was a question from Chris, Rebecca, sorry, apologies. I clicked answer live and then pressed done because I was going to type a response. So Chris asked about the typologies. They're held by the Gates Foundation. And one of the things we're looking at is, as Junaid said, we'll have a closed repo for the rules and typologies. It's called the Thieves' Cookbook for a good reason. If we share all 270 typologies, there's a whole bunch of fraudsters who are suddenly going to get new ways of trying to circumnavigate a lot of the controls. The rules that we're creating will have both the manual controls and the digital controls that we plan to instigate. So any fintech doesn't have to start from scratch. But that process of vetting and giving access to that is a process we're working through at the moment. Chris, if you are interested, we'd love to chat to you because that's one of the big questions we didn't cover off in this demo. There's a whole model that goes behind it called Apricot. You know, for the purposes of the demo, it didn't have as much value, but if there is something you know, that you want to discuss, I'm more than happy to discuss that with you, because that's something we are trying to make sure is available in a controlled way.
Thank you, Rob. And we've had a really interesting question through around quantum, and would quantum or quantum-inspired tech help with the vast amount of calculations required?
Good question. If someone actually knows how to answer that and wants to join, we're using a basic rules engine. Sorry, we're not advanced enough as machine learning. One of the things this did teach us is that we need some data scientists. It's an open source product. If someone's got some ideas and thoughts in that, please do feel free to reach out to Junaid and myself. We would happily have some proper insight. We've got the resources to throw at this, so yeah, please come and talk.
I mean, even with machine learning, we have to be wary as to the sort of people and our potential users of this. If this is somewhere in Africa, they may not be able to have all the bells and whistles, and so we need to have a system that can cater for both sides of the market.
Thank you. An important point there about jurisdictions and applicability across jurisdictions. Thank you both very much indeed. You have teed us up very nicely in your presentation for our next demo, Sedicii. Welcome David Cunningham, who I think is leading off for Team Sedicii. I can see you've started sharing your screen, so I assume you are ready to go, David.
So at Sedicii, we are focused on providing world-class identity and security solutions to prevent financial crime and enable commerce. So we're really focused on delivering certainty in this digital world in as simplified a manner as possible. We have a really good team based, about 20 of us based in the UK, Ireland, Germany, Belgium and Tenerife, and entirely focused on really delivering great solutions. The work in the sandbox for us, you know, it was really great to get into the sandbox. We were looking for collaboration with teams, learning from mentors, hopefully some interested parties to use our technologies. And we got all of that and more. As I'll demo in our collaboration with LexTego in a moment, you'll see that we worked really closely together, which was a great learning experience. Synetics Solutions, we really feel there's a lot we can do together there. And we are looking for some research opportunities with MPC for AML. The mentor engagement from Jonathan Frost for us has been invaluable, and also Denise Rudich, really just to lean on that expertise has been fantastic. The facilitators who see so many of these solutions, Matt, Teresa and Mary have been great too. And the good news is we have a lot of interest in this technology. So let me just move on to that, but just want to get in a really important thank you for this process. So what are we doing? So we've got a background in digital identity, but our focus in this sandbox has been in with our solution, which is using privacy preserving technologies to fight financial crime and particularly AML. So the big problem with fighting financial crime is that organizations, if they were able to share information in more granular detail more freely, they could actually reduce financial crime. But the problem around data sharing is that the data has to move or it has to be pooled, and that brings all sorts of problems. Our solution, Prexa, allows institutions to leave the data where it is at the bank or institution, but allow insights or knowledge around that transaction or individual to be shared between the parties without actually disclosing the underlying data. So we find that the best way in order to avoid leakage of data or potential compromising of data is to never move it in the first place. So we use this zero knowledge proof and secure multi-party computation to enable a risk score to be created while the data stays in place. And Miguel, our CTO, who likes to call it fancy maths, he can answer questions on this later. But the great thing is that privacy and confidentiality are fully preserved. So on to the pilot itself. So LexTego, with their phenomenal capability to analyze 10,000 transactions per second, were able to look through reams of data, and you'll see the blurry details in the background at the back of this slide is the reams of stuff that they sent to us. And then they they assigned a risk score. And as they mentioned, there was a particularly high-ranking gentleman called Russell Hunter who seemed to be up to no good in their data set. And I'll show you a demo as to how we had a look at Russell in a moment. But the key thing is that we worked with LexTego to build a framework to allow the banks to communicate. And this enables a lot of time to be saved for banks, a reduction in false positives, and a lot of unnecessary SARs being filed, and ultimately preventing financial crime. So we built this framework which asks questions around the payment instruction data and also around the suitability of the sender. So you can explore the demos, it'll be on the website, but let me just show you it real quick here. So here we have two banks, Bank A and Bank B. Neither party shares the questions to their to the answers to the questions with either party. We use secure multi-party computation to do this, but each bank answers questions about the suitability of their account holder and also about the transaction details. So here we see Ashley Scott has been trying to pay British Telecom, but in fact, this bank account details we learned from the process actually are associated with this character, Russell Hunter. And both banks really answer the questions as per the framework, and the process is executed, the multi-party computation runs, and what comes back is an advisory to say, look, there's going to be some issues around Russell Hunter here because he has a lot of SARs filed, he has and his account has been on hold in the past too. So this will come back with the details that there's an identity and suitability issues around this transaction and further investigation is needed. The good thing then, just zipping on here, is that the Bank A, who was in fact our friend Ashley's bank, they have identified that there's been a lot of transactions to this account of Russell Hunter with these account details, and it seems like, in particular, sorry, I'm pressing the button here, that Brenda Core has in fact been very active in transacting with this Russell Hunter, and it looks like that that she may be an accomplice to the fraud that was being perpetrated by Russell Hunter. So let me just refresh this. Excuse me, it's just after, of course, live demos would pause. But what has happened is that that Brenda and Russell have, in fact, as we've ran our execution on the data in the past, have been colluding. She has knowingly been sending money to Russell, it seems. There has in fact been some SARs filed on her in the past year, but it wasn't really as obvious until we had, number one, LexTego's great analysis of the transaction data, and secondly, our ability to find additional information related to the transaction from using our secure multi-party computation. So in essence, really, we've found the process really fantastic for dealing with, for learning, for testing our model and bringing it to life, and look forward to the next steps with LexTego, with Synetics Solutions, and plenty of the other organizations that expressed interest. So welcome your questions, and Miguel, our CTO, is also here to handle any more technical ones that may come in.
Thank you very much indeed, David. That was a really comprehensive overview. We've had a couple of questions come in. Someone's asked, since legal compliance responsibility cannot be rolled over, how can the data recipient bank feel comfortable that what is shared is actually valid without seeing the actual data?
Yeah, Mig, do you want to take it, or shall I?
Yeah, that's a very good question. It's around the data governance model in the communication. So typically data governance expands to just within the bank, but in this case, a global data governance model is required for the collaboration between the banks that makes sure that the quality of the data contributed to the computation meets basic standards. So we can think about audit processes in place that are certain and make sure that that quality meets the standards. We can also think about the algorithm making some basic checks on the syntactic interoperability for the data. So to make sure that dates and passport numbers and some other information meet the specific requirements for the computation to take place. But it's definitely a problem that needs to involve the two organizations or multiple organizations in the computation to make sure that that quality meets the basic standards.
Thank you very much. And stepping onto that around the kind of engagement between banks, I mean, this solution benefits when more banks are involved. At a practical level, how challenging is it for banks to implement the solution given their challenges around legacy systems and data quality?
The good. Oh,
yeah,
sorry.
go ahead, Dave. Sorry.
The good news is that the banks don't have to get permission to pool data into a central database, which is really a big saving. And we've designed it to be deployed on site at the various banks, thanks to Miguel's great engineering. Mig, you might like to follow on.
Yeah, it's a simple SDK that it's deployed on premises, and it just needs access to the data, but that data never leaves the system. So it's very easy to interface it to existing transaction monitoring systems and legacy systems.
And the good news is we've got a network of banks in Switzerland now going ahead with a full proof of concept using this share with real data, which has taken us a number of years to get. But we really feel that this technology is its time is now coming.
Wonderful. Thank you both, Miguel, David. Thank you both very much indeed. That was really helpful overview, and thank you very much. So moving on to the next team. I have to confess, I'm not quite sure how I adequately say this. Team MPC4AML, which I think is being led by Marie Beth. So over to you, Marie.
Thank you everyone for your presentations until now. I think it was very interesting to hear what everyone is doing, especially the presentations from Brandon and David. I think what we are doing is a sort of, you could see it as a sort of combination of those two. So I'm happy that they were first. Well, my name is Maribeth van Egmond. I'm a researcher at TNO, which is the Netherlands Organization for Applied Sciences. Which is an independent research institute in the Netherlands. And we are working on a project that is called MPC4AML, so Secure Multi-Party Computation for Anti-Money Laundering. And this is a shared research project between TNO and two Dutch banks, Rabobank and ABN AMRO. Well, what are we doing in this project? Well, we are researching the feasibility of using secure multi-party computation for anti-money laundering. And secure multi-party computation, or MPC as I will call it, is a cryptographic technique to jointly analyze sensitive data without sharing it. And this technique actually enables a group of banks to perform analysis on the entire transaction network, so the combined transaction network, without having to share their individual transaction data. Well, David already sketched the problem of data sharing in such a transaction network very clearly, I think. And what we actually want to do is do an analysis using this new technique. And what we run into every time is that this is actually a chicken or egg problem, because we have this technique that enables this group of banks to perform this analysis. But then the question is, what analysis do you actually want to perform? Because there's no ready-made AML algorithm that we can perform, because this possibility has never been there before. So our starting point was to think of an algorithm which has an added value where MPC has an added value. So where collaboration of these banks is actually needed. And this is what we call the risk propagation algorithm. And I think when I heard the talk of Brandon, this is really has the same idea, namely every account gets a risk score, which can be based on cash or high risk geographies or cryptocurrencies or anything. And this risk score is being propagated through the network, which means if you look at this picture, that if a risky account sends money to an account that is not considered risky, then its risk score increases. And well, MPC actually makes it possible to securely use these risk scores from other banks to update your own scores while keeping your sensitive data, so your own risk scores, private. Let me go to the experiments. So I want to talk a bit about 2 experiments today. What we did in sandbox data, which is mainly mathematical analysis of this algorithm. And we also performed some experiments on another data set, which is outside of the sandbox. But I think for demo purposes, it's nice to show you. Well, in the sandbox data, we used the synthetic transaction data. So that contains the source, destination, and amount of these transactions, which is what we actually need for risk propagation. But actually, to validate the algorithm, we need some more additional features, such as cash transactions or money laundering patterns, which were not in this data set, unfortunately. So that's why we also looked at the other data set. And we mainly focused on mathematical analysis, such as convergence and distribution of the risk amongst a transaction network. Unfortunately, I don't really have time to talk about that now, but here are some nice pictures. Well, it definitely gave us some more insight into the algorithm that we came up with. So let me go to the second experiment. So we investigated the effect of this algorithm on some patterns that were included in this data set, which are mainly gather, scatter, scatter, gather, and cycle. So you could imagine a pattern such as this one. But for the demonstration, I want to focus on the so-called gather pattern. So imagine we have 5 accounts that are distributed amongst 3 banks. Then if the accounts of Bank A and Bank B have a high risk score, for example, because of cash transactions, and they all send money to an account in Bank C, then the account in Bank C cannot see this because the account or Bank C cannot see the risk scores of Bank A and Bank B. But using MPC, we can securely send these risk scores from Bank A and Bank B to Bank C, and Bank C will see that his account is suspicious without actually knowing the scores of Bank A and Bank B. So that's what the MPC solution is about. For now, we just look at the effect of risk propagation on this pattern without the division on banks. So then it looks something like this. We have start situation with these 4 suspicious nodes, and there's this triangle node that we actually want to catch. But then our research question was like, what happens if we perform this algorithm? Well, then you see if we do 1 iteration, you see that the score of the triangle increases a bit. And if we do 2 iterations, it increases even more, and 3 iterations more. And then you see, here you see the same thing again in a small demo. And what is our main observation of this is that it is possible in this case to detect this triangle account. But you also see that the initial risky nodes, their score drops. But if you look at the scores relatively, then you see that that it's quite even. So that means that we need to add some kind of scaling to this algorithm. Yeah. So just to go back to the situation of the 3 banks, you see that here we achieve actually what we want if we would do this in a secure way, namely that Bank C sees that his account increases in score without actually seeing the scores of the other bank, because they are kept private because of the use of secure multi-party computation. Yeah, so that was my story. Our conclusion is that this, at least for this pattern, this risk propagation seems useful. And our next step is to build a proof of concept where we implement this algorithm in a privacy preserving way. Yeah, that was it.
Thank you very much indeed, Marie-Beth. We've had a comment through from an attendee kind of reaffirming the importance of the question you raised about the compliance responsibility, and I can see someone is leaping in to answer and engage on that topic. So I would point you to that as well. Any other questions coming? Any questions coming through for Marie-Beth on her presentation? I'm just double checking the time. We do have a couple of minutes if there are any questions coming through from Marie-Beth. How do you ensure that the banks use standardized ratings, Marie-Beth?
I think if I understand correctly this question, you are talking about okay, yeah, I think I know what you mean. Like the banks, so if one bank says a risk score is 0.5, does that mean the same thing as that another bank says 0.5? Well, I think that has to be discussed that has to be agreed on in advance. But now in my story, I think these risk scores are very general. But when we want to use these risk scores will be more specific. Maybe there will also be like a vector of risk scores where one is, for example, about cash transactions, and the other one is about high risk geography. So the definition of these risk scores should be more specific than the way I present it now, and then hopefully this will be aligned in the right way. But it is an issue, of course. It is something we should think about. Yeah.
Lovely. All right. Thank you very much. That, I think, has brought us to time. Thank you very much indeed for your presentation, Marie-Beth.
Thank you.
I'm going to come now to Norbloc. We are in the final run of presentations. Norbloc is the first of 4 left to go, and we have Manos, who is leading the team there, I believe.
Hi, it's actually Simon.
Sorry, Simon.
No worries. Good morning, everybody. I'm Simon, and we're Norbloc. We're on a journey to, sorry, let me just get my screen up. And we're on a journey to redefine KYC through our onboarding and data sharing utilities. And so the demo that we're going to be running for you today is designed to showcase how our Fetus KYC data sharing utility, which is built on blockchain, can help prevent fraud and scams and allow institutions to be more proactive. So the first use case that we presented back in December's demo day is based on utilizing the KYC ecosystem to both enhance the customer onboarding experience, improve the quality of the compliance data that's being captured, and then also being able to share suspicious transaction data without sharing proprietary or sensitive competitive data, and then still respecting privacy regulation. So in our first demo day, we looked at how 2 institutions with the same customer can share the suspicious transaction data and basically ensure that they can secure customer accounts if there happens to be a transaction that's flagged through the ecosystem. And so today we wanted to share an additional way to deploy the Fetus ecosystem so that there's a more proactive element to preventing fraud and scams. Based on our conversations that we had with mentors and regulators and other participants in the sandbox, one of the things that we found is that the current process of submitting suspicious activity reports to the NCA is siloed and not very conducive to proactively preventing fraud and scams. So what I wanted to demo for you today is how to utilize the ecosystem to submit and share the suspicious activity reports with the NCA and across institutions that have a relationship with that entity or customer. So that being said, let's take a look at how that works. As we're seeing here on the portal, we can see the company details, such as the UBOs, the KYC status of this customer, and any other relevant information. And so once we go through this process, we'll select what suspicious transaction this particular customer has that is of concern. And once we do this, we'll, in a production environment, we can submit documentation, et cetera, and report all of this into the NCA so that the NCA can take the appropriate action when they're reviewing the suspicious activity report. All of this is customizable in the platform for the needs of the individual institutions and also the ecosystem as a whole. So once we submit the report, we'll go into our dashboard as the regulator, so in this case, the NCA, and we'll see that the suspicious activity report has come through. And again, as mentioned, in a production environment, here we'll see all of the documentation or data that is relevant to investigating whether this is an actual valid transaction report or activity report. And based on this, the NCA can make a decision whether to confirm that this is indeed a suspicious transaction or kind of escalate or do whatever it needs to do. So once this is confirmed, if we are Anglia Bank, which is also part of this ecosystem and actually shares a relationship with this customer that the SAR has been filed against, we can go in and see that there's a report that comes through. Now, all of the information that's shown here is information that already has been gathered on the ecosystem and is not shared. So nothing proprietary, no information around the client relationship or what bank reported the SAR is shared with banks on the ecosystems to protect the privacy and the proprietary information. But essentially here, what we'll see is that there's a remark that several linked cash transactions have been linked to this account and or this entity, and that essentially this allows Anglia Bank to make a decision on how to secure this customer account and ensure that it's preventing any further fraud and scams from taking place. So all of these workflows, again, are totally customizable and ensure the privacy of all parties involved. And the benefit here is that the blockchain-based ecosystem means that there's an immutable record ensuring the accuracy of reporting and enabling auditing from regulators and parties that are vested in this ecosystem. So that's our demo for how to prevent fraud and scams with the Fetus ecosystem, and more than happy to answer any questions or discuss anything further.
Thank you very much indeed. And just because we had this slight technical glitch moving between slides, we'll give you that time back, Simon. So we won't cut into any Q&A. Is there any Q&A coming through from anybody? Any questions, burning questions for the team at Norbloc? Okay, so I mean, I suppose a kind of a really practical one. What do next steps look like for you, Simon?
Next steps, great question. So I think for us, the next steps are to kind of get feedback around the utility and I guess where we might see some gaps in the needs from the various stakeholders here, whether that's the regulators that would be involved or institutions, and really understand how we can further build out functionality to support those needs.
Lovely, thank you. And you, as part of that, I mean, you are really imagining that those conversations will start to happen with banks in terms of an implementation pathway?
Yeah, I think for us, we're open to having conversations with banks and regulators, and based on our existing production ecosystem that's live in the UAE, we've worked with both parties to ensure that the solution that is deployed is deployed easily across all of those partners and done in an equitable way, so that there's no one party doesn't have more of a vested interest than another.
Perfect. Thank you very much indeed, Simon. I can't see any other questions through, so I'm going to wrap us off there with our thanks and move on to Team Futures. Ravi and Andrew, I think you are presenting on behalf of Team Futures.
Good morning, everyone. My name's Ravi. Andrew should be on the call as well. We're from Team Futures at BAE. we'll get straight into it because we don't obviously have much time. Just a quick intro to Futures. So we are the in-house innovation team within BAE Systems, creating new strategic capabilities for our customers. And it's kind of to that end that we wanted to get involved with the sandbox. So quickly whip through the first bit. We were dealing with use case 1.3, which was about looking for deployment of technology to detect patterns or other indicators of consumer behavior. Our approach to doing this was to trial a new BAE Systems developed technology to explore how risk could and should be flagged in real time. Some of the key features that we wanted to test with our new technology on Sandbox were looking at those kind of real-time aspects. So we were looking to test out near real-time incorporation of input data and analysis. Near real-time incorporation of input data and the analysis on the impact on resolution and risking. Crucially, without the need for a batch rebuild, we know that's one of the kind of the gold standard of analysis is doing a big batch build to get some really significant complex analysis out. We wanted to see if we could bring some of those capabilities to real time. We wanted to test out the ability to define groups of interest defined by a flexible set of characteristics and features that we or our customers decide are important and extract those results in near real time as well. We wanted to look at whether or not we could persist those groups and then receive proactive notifications so that operational users could actually do something with that information. And finally, we wanted to test out whether those groups of interest could themselves be grouped into networks to try and identify wider scale and organized attacks, again, in real time. So, quick overview of the progress that we made. So, these are kind of the things that we wanted to try out. Number one was deconstruct fraud typologies into identifiable behaviors. We've done that. We wanted to configure our engine to identify these behaviors in real time. We've done that. We wanted to group these instances of identified behaviors into networks in real time. We've done that. And finally, we wanted to close the loop by using our findings to trigger friction and explain our findings to the end user. And that's where we've started, but we haven't quite finished. So, having gone through all that, very quickly want to take you through a quick demo video. So I'll just talk over this as it goes through. This is a kind of MVP user interface that we built for the purposes of the sandbox. And I'll just start talking you through it as it comes up. What you can see here is the alert screen. And in a second, what you'll start to see is alerts populating into here. These alerts are actually being generated in real time. So as data's been fired in under the bonnet, those that are interesting get popped up on here. And you can start to see that this alert window is filling up. So this really is happening in real time behind the scenes. In just a moment, I'll just push it forward actually, we select one of those to have a look at what's in there. What we can see here is an entity that's been selected along with the transactions around it that are interesting. And we can see just down the left-hand side here that in this network graph view, we've created what we termed a group of interest. And we have identified some group attributes, so the total incoming, the total outgoing, as well as per edge, different attributes as well. So actually all those attributes kind of carried through into this visualization interface. I'll just go back a second. Clicking on a different attribute, you can see actually different properties come up. One of which is that the channel has changed to cache, the amount has changed. You can't quite make it out on this video, but these arrows are directional. So what you can see here in total is where did the money come in from a BBL loan in this case, and where did the money go out to? So lots of different transactions, kind of capturing all of that financial flow. The next thing we wanted to do then was to group that up into a network of associated entities and additional activities. And again, we did that in real time. So what you're seeing here is a network that's been constructed in real time based on alerted characteristics. So we defined some risk rules, which generated some alerts, which subsequently led to this network graph being built. This is the kind of capability that has historically been kind of restricted to batch batch analysis, but we're starting to bring that much closer to real time now. And I will just run through a little bit because you'll see a couple of network graphs pop up here. This like smaller one here as well, which is a little bit easier to follow. But what we can see on this one is that we've got a business here, a business here, and a business here, and they're all connected by a couple of common individuals. So that's the kind of network typology that's pretty common that we expect to see when we do, like I said, our traditional analysis. That was a really quick run through. Everything you've just seen now was pretty much built for the sandbox. So from our perspective, what's been really exciting is that from a technology perspective, which is kind of how we've taken a focus on this, we've managed to do quite a lot of stuff during the period of the sandbox. We've extended our data ingest framework to accommodate new data we've never seen before. We've added a whole bunch of new features to our core analytics engine to generate the insights that you've just seen. We've validated that our flexible risking framework can actually identify the things that are required. And that was all stuff that, again, we hadn't seen before. We didn't have to extend our framework too much actually to do that. We developed a brand new user interface, an MVP one, because actually we realized that we needed to see how we needed a different way of interacting with the data to how we previously been doing so. And finally, and probably most importantly for us, we demonstrated that alerts can be dynamically raised in real time as new things come into the system. So what next? We've had really good fun working on the sandbox, and it's really helped us kind of iterate our technology quite a lot. We're now looking for partners to experiment in an operational context. Clearly, synthesized data is brilliant and it takes you up to a particular point, but there is a point at which you want to get some real feedback from real users. So that's kind of where we are. We'd like to gather feedback about how well our approach of bringing stuff closer to real time solves our partners' problems. Interestingly, the third aspect of this, we want to explore the impact of real-time interventions on business processes. If your alert screen is filling up, literally second by second, what does that mean for your fraud intervention processes and practices? To establish or to kind of flesh that out a bit, we've actually commissioned some internal research on this already because we think it's a pretty substantial question and will have quite a lot of impact. When you get these slides, if you're interested, just click on the box at the bottom and you'll get an email pop up, which you can send over to us. And I will stop talking there.
Thank you very much indeed, Rowan. I think that final point you raise is a really interesting one, isn't it? It's around, behaviour change and actually how that interface will work in practice with people and that engagement. So I think it's a really interesting piece of research that you have commissioned, and I'm sure there'll be lots of interest in it. A couple of questions coming through. Could you expand on the benefits of real-time monitoring versus batch monitoring? And you mentioned adding friction into the journey. Could you give us some examples of what that might look like, please?
Okay. I'm going to ask Andrew to step in on the first part of the question, and actually the second question as well, and I'll chip in at the end.
Fine. Yeah. So I think for me, the benefits of the real-time capability are about being able to take into account what's just happened for then subsequent events. So I guess if in some of the traditional systems, even if, say, an application for whether it's a loan or for an insurance policy or something like that can be scored against a batch build system, the data about that thing often isn't incorporated until the next batch run. So that means that if someone is testing the waters by putting in a number of different claims, you often can't pull that picture together until later. Whereas in this world, we can do that. We also have some, it means that we can also offer other use cases for things like when, and I guess this speaks a bit to the intervention question, that data is immediately available for people like call handlers. So if someone's called up about something that they've just done, we've already assessed it against risk, or we can at least see where it sits in the network. And so they can perhaps change the routing of that customer appropriately as to, whether it's a simple thing that they can say yes to straight away, or whether it's something that requires further investigation because there's risk associated with it. So it really, for me, at least in I guess in this sort of financial crime context, it's all about being able to have that up-to-date picture. We've got some other use cases that we're working on that are much more in the sort of law enforcement space, and there obviously having that real-time incorporation of data is important in terms of sort of interventions there and risk scoring events as they happen.
I'm going to add to that. I think it's relatively well established to assess transactions in isolation in real time. It's pretty novel to contextualize that as fully as we're proposing to do here to get a really rounded view of the risk. And I guess bringing that back to a real life situation, we were talking about vulnerable customers at the start, and I'm going to hypothesize here, a kind of elderly vulnerable customer will still go to a bank branch. Imagine having the capability to process that elderly customer's transactions and get it whipped around the entire technical system within 3 or 4 seconds, so that if something is of concern, you can catch them before they've walked to the front door, and you can say, actually, do you mind if we have a chat about what you've just done? Because actually something here doesn't look right. And I know that's quite an emotive use case, but I also know that that's something that UK Finance were interested in with the Take 5 campaign, about trying to find people who had been coerced into particular financial transactions. So if you've got the whole system working behind you so that you can catch them before they walk out of the branch, that's pretty powerful.
Indeed, thank you. I think that the point you raised and really bringing it back to kind of, who are we solving on behalf of, and where does the harm sit, I think is a really important reminder for us all. Thank you very much indeed, Team Futures. Just 2 more teams to go. So I would like to invite Team Onespan to step forward, and I think Sharon Lee and Professor Stephen Murdoch are taking the floor for Team Onespan.
Okay, thank you. So hello, I'm Sharon. I'm a researcher at Onespan. Our project is about building up the adaptive learning algorithms for fraud detections. So first of all, I would like to talk about our progress. So the objective is to build and test some adaptive learning algorithms using the FCA Digital Sandbox. In particular, we are interested in the device data and transactions banking data. Our data scientists, including myself, have analyzed the data sets. We have implemented, tested, and compared several machine learning algorithms. Some are static and some are adaptive. We did improve the fraud rates in the review and the reject categories. We also have our internal fraud consultants involved in the project. He reviewed the data set and brought in some matter expertise to support our work. So I would like to use the device data to explain the challenges that we have in the domain of fraud detection in digital banking. So in the data set, we can see there are 35 columns. The number of transactions is 5 million, and within that 5 million data points, there are only 2,997 fraudulent transactions. The fraud rate is 0.06%. As we can see, it is a very extremely imbalanced data set. On the right-hand side, we can see the details of the fraudulent transactions. Scam is the most popular one, and then we can see red. And depending on the human expert, some people will put fraud in the labels. And we also see quite a lot of fraud are the first-party fraud. So the first question that came up is, do we actually have enough good features in the data set so that we can separate 2 classes? As I've also mentioned, it's an extremely imbalanced data set, so it is quite challenging for the machine learning algorithm development. Another limitation about the data set is many data sets, they are not interlinkable, and it means that we can't actually leverage the alternative data set. So if we believe the FCA synthetic data is a good representation of the real world, then it will give us some idea on the performance of the fraud detection system nowadays. So the fraud detection system did classify all the transactions into 3 categories: the pass, review, and reject. Within the reject category, it means that the system will reject the transaction directly. And there are only 15 fraudulent transactions out of 540. For the review category, it means that we require human expert to view the data point one by one. Within the 33,000 data points, there are only 318 fraudulent transactions. And in the pass category, actually it contains most of the fraudulent data points, which is in total 2,665. From this statistic, we learned that the fraud detection system is doing something. The fraud rate in the reject and review categories are much higher than the average. However, most frauds are still in the pass category, and it can pass through the system. Here, I would like to show the normalized histogram of the fraudulent transaction versus the genuine transactions. There are 2 columns in the dataset called the policy score, which are divided by the human rules, and another one called digital trust ID trust score, which is divided by some probabilistic matching algorithms, and it will tell you how reliable is that digital ID. So for the fraudulent transactions, which is again is 0.06% of the population, you can see the normalized histogram distribution is like this, and this is the genuine data point normalized histogram, and here is the overlap histogram. And as you can see, the fraudulent transactions perform fairly well in the digital ID trust score. Some of them are very good. While the policy score looks like more effective, and many fraudulent transactions have lower policy score. However, if we take into account on the very small number of fraudulent transactions, it is still very challenging to separate the fraudulent transactions and the genuine transactions without having a very high false acceptance rate. So before we look into the dataset, we hope that we can have some nice engineered feature to separate 2 classes so that we can find a clear or a nice decision boundary. However, the reality is we found that 2 classes are heavily overlapped with some great reasons. First of all, humans do change behaviors. And more importantly, many frauds are conducted by trusted device, for example, the APP fraud. So for the next step, what we would like to do is do more research and experiment to improve our existing adaptive algorithms. We would also want to leverage the machine learning algorithms to assist experts in the development of rules. More importantly, I personally believe that we do need to design new features for fraud detection system, just like what CallSign is doing, but we need to do something much more. It is also important for us to consider the combination of different data sets, which can help us to prevent new type of frauds. So that's it. And any question are welcome.
Thank you very much indeed, Sharon. Any questions from the group coming through from our audience today? Okay, we've had one coming through. Does this type of solution require the customer to have specific devices such as a smartphone or laptop? And will it support customers segments who particularly use telephony? So, I mean, that's very pertinent for the kind of older and more vulnerable segments, I think.
We do not have the information in the data set regarding the segment or the type of the customer. In the data set, we do see the transaction data from different devices. So what we have done is try to get the first 20% of the data to learn some global parameters and try to use the parameters to set up the threshold and run on the remaining data set. We do find that using this kind of adaptive learning algorithm can help us to categorize more fraud into the reject and review category. But from what you can see from the data, we do have limited human power. Banks doesn't like to have too many alerts, and they don't want to handle the alerts that they can't handle. So there are really restrictions on how many data points we can put into the reject category and the review category. And when we develop the algorithm, we need to take that into account so that it is realistic to be implemented by banks.
Thank you. And I think that touched upon a piece of research that Ravi was mentioning about earlier, wasn't it, about understanding what banks are going to do with the proliferation of alerts coming through. Thank you very much, Sharon. I can't see any other questions coming through from the team. So unless you had any kind of closing remarks, I will thank you and the team very much indeed. And come to our final presentation of this demo. Team Trust Stamp and IT2 fraud signals being led by Adam Ridgway. Adam, are you ready to go?
My name's Adam Ridgway, and this is Trust Stamp's IT2 fraud signal sharing. So we've actually partnered alongside CFAS, Lloyds Banking Group, and One Banks for the delivery of this. And then on the line as well, we've got Jacek, who is our technical project manager for this. Okay, so cases of identity fraud rose by 18% in 2019 with a 32% increase since 2015. And this is pulled from the CFAS Fraudscape report. So 87% of this occurred via online channels. And my guess would be that post the pandemic, this number is going to have a huge increase. So we've got a unique solution to this problem. And that's based around detecting the fraud through the biometric. So the one variable that the fraudster cannot change is their face or their biometric. So what we can do is we convert the biometric template, which is typically captured during the customer onboarding or during enrollment, and we convert this into our proprietary IT2, our irreversibly transformed identity token. And what happens, and by doing this, what happens is it enhances both the security and the privacy, in that we can then discard the original biometric that's been we can discard the original biometric template, and this then allows us to authenticate users without the risk of biometric theft. And additionally to this, and what we've done for this project, is we're then able to probabilistically match or compare these tokens as a means of identifying fraud. So we can match, verify, and deduplicate against these tokens. So what we've done is we've created a watch list of IT2s, and this essentially acts as a biometric safeguard that denies access or acts as a flag if there's been a match or when there's been a match. And a way of doing this is you could have multiple watch lists made up of known fraudsters, or you could have watch lists of enrolled customers. And where there's a match, this would be as a signal for identity fraud, highlighting which could highlight velocity attacks over a very short period of time. So as you can see here, the fraudster through the fraudster's data or their IT2 can then be shared across multiple organizations without the risk of breaching GDPR or any data privacy regulations. And this is because once we've tokenized that data, it's no longer deemed sensitive information. And then we can do this in real time, which allows that ability to create a shared biometric fraud network. Additionally to this, we can query these tokens using zero knowledge proofs to extract sort of binary yes or no answers. And what we originally intended to do was we were going to use a sample of the live CFAS data, but we ran into some InfoSec issues where we were unable to do this. So instead, we've replicated this and we've used images that we've collected internally alongside sort of driving license and passport documents. So what we've done is we've had 30 images of 15 real people. and 15 of these were then used to make up that watch list that you can see on the top right there. And that's to replicate the CFAS database of images associated with fraud. And then additionally to that, we've got the fraudsters in the top left, but that is those 15 images essentially replicate that bank enrollment process. And additionally to that, we've then got 13 images of 13 real people, 40 US driver license images of 40 people, and then 18 UK driver license images and passports of 18 people. So what we've done there is we've used the driving license and passport images to replicate images of real life, of photos taken of real life IDs, where there might be differences in the lighting or the image quality, just to make sure that they're not perfect. So we've got a total of 101 images of 86 people, and the expected results would have been that we would match the 15 images of the bank enrolled customers with the watch list. And then we would have had 71 images passing as genuine or non-fraudulent users. And that's exactly what we saw. So this shows the results of our test here. We've set the score value there at 0.6. And any of the anything that matched below that 0.6 would indicate a match. So what we've done here is we've got 15 unmated pairs and making up the 30 images of 15 people, and then we've also seen the unmated pairs, and as you can see here, we've got 36 images of unmated pairs, which totals 72 people. So what we do have is that additional match, but this is expected as we've got an uneven non-mated pair. So this is consistent with the expected results highlighted before, and really shows the power of the IT2 token. So as a way of next steps, that we were limited with this test, that it was a very small data set in the end. So what we would like to do is use a much larger data set and prove out its scalability. Additionally to that, if we could revisit what we intended to do and use the live data from the CFAS database, or a sample of that, then that would be ideal. And really what we'd like to do is use multiple watch lists to highlight a velocity attack across organizations. So as you can see here, we've got this little image. The way we would like to do it is we'd have 3 separate watch lists, where we've got an IT2 associated with fraud, a temporary IT2 database, and the IT2 master database. And as that enrolling customer goes through, he would then be added, or he or she would then be added to the temporary velocity database. And if there was a match over a set period of time, this would highlight a velocity attack. And just to highlight a few use cases, so identity fraud, KYC, AML. So we've actually we've run a pilot where we've used our deduplication technology against the PEPs and sanctions watch list, just to clean up any inconsistencies or false positives in that data, and then as part of that frictionless or onboarding piece as well. And then if anybody wants to reach out or has any additional questions about this, feel free to contact me on that email address in the bottom left corner there, aridgeway@trustamp.ai. Thank you very much.
Thank you, Adam. That was really interesting. Thank you very much indeed. I've had a couple of questions through. With biometric, you'll be able to see this as well in the chat. With biometric, what if a fraudster opens the account? The biometric would be theirs. Any insights on that?
So if the fraudster was open to open the account, so typically what we'd catch is any mismatch in PII information. So say for example, the fraudster was using a fake ID with his real image on there, as well as his biometric. When he would enroll, and we generate that IT2 token. If they've enrolled previously or they're part of that database, what we would then see is that there's a match in the biometric, but a mismatch in that PII information.
Okay.
And then that would flag that as a potential fraudulent duplicate.
And then we've had a kind of a follow-up question around kind of the known challenges with facial recognition. particularly those with darker skin tones, and the kind of the challenges around structural inequality. What specific criteria are you as a team using to determine the point at which it will be legally and morally legitimate to put faith in the ability to use watch list pictures?
So we train our AI on various data sets. So we've got a rounded and diverse collection of data. So from that, we're fairly happy that what we're doing doesn't have any bias in it. And then, sorry, what was the other part of that question?
So at what point would what criteria are you using to kind of assess at what point it will be kind of morally legitimate or legally legitimate to put faith in the ability to use watch list pictures?
Okay, I'll pass you over to Jacek to answer that second part of that question.
So I will actually add something to the first part first. So at Justin, we are very committed to assessing the impact of racial bias on biometrics. And one of our research projects actually proves that our technology does not have a significant racial impact. But that's something that we can pursue offline if that's something that you're interested in. On this note, we do have some other projects that we are pursuing with other biometric modalities, which include fingerprint, palm, and voice biometrics. And we also have another project where we are pursuing breaking vendor lock-in. So in case you are not comfortable with using facial biometrics, you could switch to using, for example, fingerprint data, and you could potentially use it across vendors. So you would have one fingerprint vendor and a second fingerprint vendor where you could compare these two. So we do have multiple projects that deal with this specific issue. On this note, there are specific things that we are doing inside the watch list, which actually account for the fact that there is a high chance that people, not only with darker skin, could potentially match with each other. So we do have assessment projects that are currently ongoing as well, which are supposed to set the threshold at a specific level, which will account for this, which is something that we've been doing consistently since the beginning of the watch list, just improving the biometric solution behind it.
Thank you. And a follow-up question: if the token is still linked to identifiable data, within the system, doesn't the token then remain personal data under GDPR?
Do you want to answer this one, Jacek?
Sure. So there are two things that we do here. So first of all, the token itself, so the IT2 token, can contain pivot points to external databases. So for example, in order to have Justin hosted, you do not amend the token with personally identifiable information. What we do instead is we point to external databases. So for example, your database becomes the single source of knowledge about this person, since that person is your customer. And that allows also for sharing between organizations. We do have other components that can be very useful in terms of GDPR compliance, which for example involve tokenizing PII. Basically, we convert PII to vectors which can be compared. And instead of sharing pure PII, you're basically performing zero knowledge proofs across organizations. So the answer to is the customer's name Jacek is no longer is the customer's name Jacek. It's a comparison of two vectors, and it allows us to make judgments without the need of sharing the data and in a non-encrypted format. So I hope that answers your question.
Thank you very much. That brings us to time. There are a few additional questions in the sidebar, so perhaps I can ask you guys to take a look and pick those up. That brings us to the end of this demo session today, and it brings us to the end of the 3 demos, the showcases that we've had across this week, marking the end of the pilot. I'm sure you will join me in commending the teams for all the work that they have done over the past 10 weeks, and for the time they have taken to really thoughtfully and articulately present to us their solutions and their progress this morning. It has been really rich and insightful, and really in its entirety with vulnerability and SME lending really starts to show the art of the possible with the Digital Sandbox. And so my thanks to all the teams. My thanks as well to the FCA and City of London teams for all the work they have done throughout, supporting the teams, managing these sessions and bringing it all to life and showcasing the range of activity. It's a huge amount of work that goes on behind the scenes. So my deep thanks to them, and to all the mentors as well who have really engaged. We've had the teams across today provide their shout outs to a few of their mentors who have really helped to kind of shape, sense check, critique and challenge along the way. And we've also seen some fantastic collaboration and participation across the different teams, which is something exactly that we were hoping to see start to develop as part of this process. So my thanks to all the mentors, my thanks to our advisory panel as well, who have been there from the start in terms of assessing applications all the way through to supporting the teams throughout their process. All the videos from today, and indeed from all the sessions, will be available on the team showcase pages of the Digital Sandbox Pilot web pages. So please do go and check them out, and please do go and share them with colleagues who haven't necessarily been able to participate today or across the other sessions in the week. As I've mentioned, we have been evaluating this as we go along, and this is a really important part of the process to really inform the next steps that we will wish to take with the Digital Sandbox. So watch this space. Thank you all very much indeed for your participation. It has been a thoroughly enjoyable and hugely insightful process, and we are grateful for each and every one of you who have participated and shaped and helped develop it along the way. So with my thanks from the FCA team and the City of London team, my thanks to all the teams who participated today. Thank you very much indeed, and do keep engaged with the Digital Sandbox pilot web pages and continue to share your feedback. Thank you all very much indeed.